I was watching this YouTube video recently that claims to have the best option strategy ever, in which you can risk only $3 to make up to $97. This is an option strategy called Iron Butterfly. And while the video goes about how to set it up in theory, I read some comments where some wanted to see it in action, which is what I'm going to do right now, and show you if it works and how do you open and close something like this, and what are the risks involved when trading the strategy, and also share some keys to trading this successfully. This strategy only has a 4% chance of winning, but I will show you how to increase it to 50% with some small changes at the end of this video. Hello and welcome back to Options ASAP. If you're new here, I make educational videos and trading ideas on options trading. For today's video, I made this Iron Butterfly trade, which lasted 4 days, and I recorded a few minutes of myself talking about it on all 4 days. I opened this on a Tuesday, and the trade was closed on Friday for the same week. I watched some videos online where this strategy was discussed, but no one really knew if it works or not. So let's put some real money in here and see if it works. I'm going to cancel everything here so you can set it up from the beginning. An Iron Butterfly is basically you sell a strangle. A strangle means a call and a put at the money where the stock is trading. So right now the QQQ is trading at 317 exactly. The markets are going to close in 5 minutes. I'm going to quickly put on this trade. So you sell the call and you also sell the put for the same strike. That's how you start, okay? Now this has a credit of 600. Now you buy some protection on both sides, okay? So if this stock crashes, the immediate protection you have is 316. So I'm going to buy the 316, and then you go to the call side, and then you buy one more protection, skip this and get the 318, okay? So once you do this protection, you get something that's very close to 100, okay? So it says close to 95, but it's kind of fluctuating a lot. So let's see how much we can get. So I'm gonna say 95, okay? So if you get 96 or 95, you're basically risking like $5 on this trade, or theoretically you are risking 5, but let's see exactly how much you're risking, okay? Shows 91, 95. For these type of spreads, getting a fill can be difficult, okay? Because you are buying 4 legs. You're basically trading 4 option contracts, and they all have their own bid-ask spread. So you're fighting with 4 different players and trying to get a fill. Right now, this order did not place. So yeah, do not just go by what you see, okay? The minimum I could get is 86. And the highest I could get is 98, okay? So it is difficult to get a fill for a trade like this, but still this is much better than some other stocks, okay? So it's still like 10 cents wide. So I got 2 minutes for the markets to close. I'm gonna even lower my bid further. Let's do maybe 92, okay? Perfect. So we got a fill at 92, okay? We tried for 94, we couldn't get it. The platform even showed us 98, but those are all unrealistic, okay? You won't get a fill, that's for sure. So I saw some comments on the main video about not getting a fill, and this is the reason. You cannot put the price which is on the platform. You have to reduce or increase a few cents to get it filled. Now that we have this in place, how this trade could profit is that the stock trades near the same range and finishes near 317 by expiration, okay, which is 4 days from now. We are hoping that QQQ would trade sideways inside a range, here comes the bell. So we are hoping for QQQ to trade sideways inside a range and finish somewhere around here, okay? And the odds of this finishing on 317 is not so different from betting on a specific number on a roulette table, which has 30 different numbers, and the odds of you getting it right is probably 1 by 30. And QQQ also has been trading inside a $30 range, and the chance of it finishing on 317 is just like 3 or 4%. So today, if you see this trade, it has been trading, highest is 98 and lowest is 93. One little tip you can do is do something called bookmark, okay? So you can basically bookmark this address, which is on the top, and after that, you can paper trade it. So even if you don't have it on, anytime you open this URL, you can look at the price of this combination. So that's the closest you can get to paper trading on Robinhood. And then we will watch over the next 4 days how this does, okay? All right, here is how it looks on the second day. Pretty much there is no change. It's kind of trading for the same price, but the stock has come down a bit. So if I open QQQ and look at the previous day, it was around the 317 range, and today it has come down a bit and trading in the 314 range. But if you see in the morning, it did come back to 317, okay? So it basically dropped and came back up, but it basically made no difference to the trade. Yeah, so if you look at the trade, it basically hasn't made much difference. And whatever value the calls lost, the puts have gained kind of same, and the trade continues to trade for the same price. Okay, the best case scenario is when you wait till the last day and maybe the stock trades close to 317 and you could potentially close it for a winner. But in any case, you're not going to make the entire 94 or 95 that you see here. You can't really capture the entire profit. And I saw many questions in the main video about how do you exit such a trade. Do you just keep it till expiration, or what exactly do you do once you open it? Well, as soon as you open, you have to put a closing order and try to close it before expiration, because if you try to keep it, your brokerage, Robinhood or anyone else, is going to close it and won't allow you to keep it, okay, to prevent risk in case you don't have the capital to buy 100 shares on the event of assignment. And because you cannot time this trade perfectly, the best case scenario when you trade this is to put a closing order immediately. So right now it's open. I'm going to say close and try to put an order something below my price. So this is like I sold this for, I didn't buy this, I sold this for 92. So I have to buy it back for cheaper to make a profit. Okay, so can I buy this the cheapest? I can buy this is 82 or 85. So if I can buy this for 85, that's like a $7 win. I'm gonna put 85. I don't think it's gonna fill today, but maybe tomorrow morning, you never know. But it's best to always put an order, a reasonable order, and hope that it gets filled. And when I do this, my collateral is released. And remember to put this, instead of good for day, you make this a good till cancel, called a GTC order, so that it will run for, oops. It's not allowing me to do the GTC. Yeah, there you go. And when you do this, it will try until the 26th to get a fill. Okay, so now even if this fills, we still have the link on the top. I have already bookmarked this, which means we can always track the price of the spread. Today is the third day, and here is how it looks right now. It's again pretty flat. and not much has changed on the trade. So right now, QQQ has gone down even further to 310 range, and our strikes are at 317. Okay, so we are looking for a move back up to 317. Otherwise, this trade is not going to make much profits. Okay, overall, it's kind of difficult to make a $300 share sit inside a 1 point range. So maybe a better strategy might be to make your spread bigger, like 320, 310, 300 or something. Okay, so another thing I wanted to show is like we still have one more day left, which means we have expiration risk. As you get closer and closer, you could be assigned to buy or sell these shares, and that can also put us in trouble. And the next risk is where, can you see how wide this looks? The bid is 75 and the ask is 115. So it has become much, much wider as the stock goes away from our strike prices. A couple days back when you opened this, if you remember, it was much closer, like 88 and 100 or 102. The difference was just 10 cents or something, but now it's become 40 cents, so it's going to become even difficult to close. Let's say you want to prevent any risk of assignment and you want to get out of this trade, you might have to pay more than what it is worth. And also I do have a pending order, right? You remember we placed a pending order yesterday for 85 cents and it did not fill, so it hasn't found any matching buyer for this combination during the last couple days. So what can you do with a trade like this? With 1 day left and less likely that it might come back up by tomorrow, you could potentially try and close this, which is what we already put an order for. We can make this 85, maybe 90, and see what happens. Or even 95, 98, until you get a fill, right? Your idea is to get out and prevent assignment, okay? And then if you had more days, but you think it might bounce, you can close one side of the call. So let's say this one is cheaper, just 20 and 29. We can go back and close only a portion of the trade and wait for the stock to finish above 317. So let's say I can buy this back and sell this. I have to pay $9 to close this. But what happens is this eliminates your upside risk. If the stock does recover and come back above 317, the put options will expire and you can keep the remaining money. Okay, this is the last day and this is how it looks right now with a few hours left to close. The spread is still about flat, pretty much the same cost. As you see throughout the week, it's been trading for the same price. Okay, so the only way this kind of an iron butterfly would work is when the stock trades inside your range. Okay, so let's look at the trade. Right now, QQQ is near 313, and we probably got another 2-3 hours to close. And it may or may not move another 400 points and finish inside this range, right? We never know. But it's already too late. I should have closed this spread in the morning to prevent any risk of getting assigned. Okay, when you have a very small account, when you can't buy 100 shares or anything of such a high dollar stock, you have to first play it safe. The profit or loss comes later, right? You first have to survive and live to fight another day, right? So you don't want any account deficit or accounts getting closed out or getting margin called or to deal with any sort of stress over the weekend of how the stock might open on Monday and what can happen to your trade, right? When you close it, even for a loss, you have the peace of mind that your account is fine, even though you took a small $5 loss. Okay, so let's say if I have to close this now, I can go and put a price. Right now, how much is this right now? It's $97, but the bid ask is better. 86.108 is way better than yesterday, where we had an even much wider spread. Okay, so we did put in a price. We put in an order to close this for $85, but it never got triggered. There was never a chance or opportunity for this spread to get closed out. Okay, so this tells you that this is not a high profitable or high probability strategy where you can win 9 out of 10 trades. You may be able to win maybe 1 out of 10 times or even less. All right, so there is nothing extra special about this, and this is not like a free money strategy. If that is what you are looking for to find out, and I wanted to test it out and show a real trade and uncover that, okay? But I do like the strategy. You should know when it works and when it doesn't, so that you can put it on when the right moment comes. Okay, now to close this, there might be multiple ways. So the first idea is to close the call side. Right now, if you see here, the 317, 318 call is only worth $4, which means you can first close this and then come to the next one and try to close the rest, okay? In case for some reason if the stock bounces, you still might be able to get away with a small win this way, okay? But for now, to make it easier, I'll just put an order. I might have to first cancel what I already have, so I'm going to go here and say cancel. All right, now this is now cancel. I can go and put a new order and try to close it. Now it says one contract available. Sure. Let's say 97. I don't know if it'll work, but let's give it a try. Normally you can wait for a minute or so and see if the order gets filled, and then you can go and revise the order and put on a new one. And still, if you have difficulty, like I said, you can always close them one by one. Okay, it's been like a couple minutes and there was no fill. I'm going to replace the order and say maybe even more, okay? Let's put even some more. This is a challenge with a four-legged option, because if it says like 100, you cannot get a fill for 100, okay? When you're opening it, you have to get less credit. So when I open this, if you noticed, I only got a credit of 92, even though it showed 96. Okay, now if I have to close it, I cannot close it for 96. I have to pay 100. So you lose $4 this way and the other way just for opening and closing it. And that's how it works. You cannot expect. You may get lucky, but yeah, you have to pay at least $4 this way when you open, because of the liquidity. That's how it works. Okay, now I'm gonna try and maybe say $1 or even 99 and see what happens. And give this another couple minutes to see if it fills. All right, looks like we still don't have a fill even for 99. At this point, I can maybe put an order even higher, like 100. 100 is like the max loss for this trade, right? So you can maybe say 101 and then put an order. Basically, I'm paying more than the maximum value of the trade just to close it as one order. Otherwise, I might have to do these one by one. But I want to show you this way so that I can explain how difficult it is to get a fill on these type of strategies. Okay, looks like I got a fill this time for 100. Even though I quoted 101, looks like it got filled for 100, which is nice. So what happened here? We opened something hoping to make profits, and in the end, the stock did not come inside our range. And what is our total loss here? We opened something for 92, and we closed it by paying $8 more, and which is our max loss. And since Robinhood has no commissions, we did not lose even more. Otherwise, you probably would have paid more for the commissions to open or close, or maybe some potential assignment fees or anything. Okay, so adding all that, in the end, this particular trade was an $8 loss, but we learned something new, right? So it's always nice to experiment and see how things work and maybe figure out how to do it better the next time. While this was a loss, what if we actually went for 312 instead of 317? Because that is where the stock is trading at right now. I created a new iron butterfly at the 312 strike with just 2 hours left to close to see how much it would have been worth. Let's say QQQ is near the 312 range. Let's look at the price of the iron butterfly. If we opened it for 312, okay, so I told you that we would sell the current price, which is 312, and sell the put, which is 312. All right, so we sell the 312 triangle, and then we buy protection. So for the put, you buy one strike below, and for the calls, you buy one strike above. Okay, now if you see this, this is trading for just $60. So let's say you open this particular spread. Oops, I made a mistake. I clicked on 312. I should have clicked on 313, right? So it should be 1 point wide. So if you look at this spread, right now it is trading for 80 cents, right? So if you open this, it would have probably got a fill, I think, for 85 or something. So you still can't get a fill for 80, but maybe you can get a fill for 84. Okay, this is the price of the spread is 82, 83 right now. Okay, so an iron butterfly would work if you can get the stock to come into this sweet spot here. Okay, it's all about luck. Pretty much, I think QQQ has been trading in a random fashion, 320 and 308. So if you can get that in the range, you can make some profits, but not too much. Okay, you cannot like keep the entire $100. You can just maybe make $10, $15 more by risking that money. Okay, now we are 20 minutes into the market close, and QQQ made a surprise recovery. It was as much down as 309, and in the last 1 hour, it makes a nice 700-point jump and finishes at 316. Okay, I was telling you about a possible recovery where this might jump, but because of having a small account and possible assignment risk, it is not safe to keep things till the last minute. Okay, so I closed it for a small loss, but let's look at the strategy. Because I have the address, because I have this link to the trade, we can still look at how the trade did. Okay, even if you closed it until 12:55, this trade was pretty flat. It was near the max loss, but in the last 5 minutes there is a huge jump in volatility, and you can see that it went all the way down to 60. But we're not sure if this is the correct price, because if you see the bid ask, it is absolutely freaking wide at 2 cents and 117. Okay, so you have no idea if you would have got a fill for 60. But still, there was a high possibility that when it jumps like that, you may have a small edge in closing it for a small win at that point. Okay, but it's not recommended. You don't want to wait. Okay, closing summary. This strategy, Iron Butterfly, is probably not God tier, but it's a very good strategy that might work on some situation. All the option strategies are not God tier. They all have their advantage and disadvantage. And if you put them at the right time, and if your opinion is correct, you can definitely walk out with a nice winner. Now let's talk about success. If you take a step back and see what we are doing wrong, we are trying to aim for a low probability outcome. Betting on just one number would mean that you had to play 30-40 times to just win once. And of course, the strategy that makes sense is to bet on more numbers. When you're going for a larger range, you can get winners more often, even though your returns may not be as big. Now let's see what more numbers mean for our iron butterfly trade. We are not just going to deploy random iron butterflies on different numbers, but make the same iron butterfly bigger. So if you look at the last 1 month, the highest price for QQQ is around 320. And the lowest price, if you can see here, is 300. Okay, so you're basically looking for a $25 range. Okay, if you just pick one number from 25, your odds of getting it right is less. But what if you try for 10 numbers or 15 numbers out of 25? At that point, if you pick a random number, there's a 50% chance that you're going to fall inside your range. So we would start by making the same trade. Maybe sell the 315, which is where the stock is right now, and also the put for the same strike. And then instead of buying the immediate next leg, you try to buy something further away. In this case, let's do the 310, okay? And on the call side, do the same thing by adding 5 more points, which is 320. Now at this point, you have a chance of making 378 by risking 120. Basically, your collateral is the width of the strike, which is 500. So if I just say 1, my collateral is going to be 500. Okay, you are definitely risking more than $3 here, but the odds of having the stock finish near this range goes up. Okay, while in Robinhood I can show you better, I'm going to switch over to Tastyworks, where they show the probability of profit for each trade. I already have QQQ open, but this is the April expiration, 1 month away. We're talking about selling the 315 call and 315 put. Okay, so we start by selling this triangle and then we buy protection. So if you buy the immediate strikes, which is 314 and 316, the probability of profit for this trade is just 4%, even though you could collect 96 cents. And you know how that goes. If you try to collect 96, you might collect maybe 92 or 90 at the max. Now I'm going to increase the width and show you how the probability of profit increases slowly as we go. Once I made it 2 points wide, you can see it went from 4 to 8%. And once I make it 5 points wide, you can see that it jumps to 20%. And you're collecting 442, which is not bad. You are risking 60 to make 440, okay? Which is much, much better than the other trade we just saw. I can even go bigger, 15 points wide, which is what we discussed first, right? The range for QQQ was 300 and 330. So if we make it even bigger and go all the way to 330, now the probability of profit is pretty close to 50%. And you are collecting around $997 for a collateral of $1,500. And there's actually so much more information at the bottom. So you can also see what is the maximum profit and the loss you could make on this trade. So here you're risking 500 to make 1,000, but the probability of winning is 40%, okay? Before, when I kept it at 1 point wide, it was showing just 4% probability of profit, and you were risking 4 to make 96, and you saw how that went, right? So you'll always have a better chance of going for a wider iron butterfly. And in addition to that, it is not just about getting the stock to finish around that range, but rather to collect the theta decay. Every day options lose value, and when you do the 330 and 300, every day this particular spread loses value. Okay, so right now the theta decay is $9. Every day the stock moves sideways, this particular iron butterfly loses $9 in value. And after 1 or 2 weeks, if you can buy it back, it will be way more cheaper and you can make a good profit. And another thing that helps you is decrease in IV. Right now the IV here is 26%. And as this IV keeps going down, the value of this combined spread also goes down. So let's say if it goes down from 26 to 22, this might be worth even less. So you can buy it back for cheaper and also get out with a win. And for this reason, an iron butterfly is a popular strategy when trading earnings. Usually options are expensive just before a company announces earnings, which means you can put on this iron butterfly and buy it back the next day for a cheaper price. So you are not just going to pin the stock inside a range, but you're going to also profit from passage of time and also reduction in volatility. And talking about volatility, 26 is not a very high number for QQQ right now, which means this is not a strategy that is best applicable for this symbol right now. I like this website called Market Chameleon, where I can go and look at the IV of different stocks. This website is free to use for anyone, and you can go here and put your symbol, and then you can look at the full chart. Right now, this is the current day's volatility of QQQ, but you can go historical and see how it did over a period of time. And by pulling up the full chart, you can easily figure out if now is a good time to open an iron butterfly on QQQ. On the top, you have the IV chart for the last 1 year, and on the bottom, you have the actual stock chart. The current IV of QQQ is close to 22, but if you look back, it was 32 a couple weeks back, and 39 on October. So this is a much better time to put on a iron butterfly on QQQ, because here it is 39%, but 1 or 2 weeks later, if you see, it has come down to 21%. So basically, it's a 15% reduction in volatility, which would have given very good profits when trading an iron butterfly. So definitely check IV before you put on iron butterflies, and don't just blindly go and deploy them every week thinking that it's going to win every time. What can happen if you randomly deploy is that you might open an iron butterfly when the IV is 22, which is the lowest. It can't go any lower. And suddenly, if something happens in the market and the IV goes up to 32, now your iron butterfly is even more expensive and your position will show a loss. If you collected like $900, when the IV jumps to 32%, now the iron butterfly would be worth maybe $100, $200 more. So always wait for the right moment before you get into something like this. To help understand this even better, I'm going to show you 2 stocks with completely different IVs and explain how significant IV can be. So right now you have Disney, which is trading at 185, and you have GameStop, which is also trading close to 180, okay? But if you go and look at the option chain of both these stocks, they will have completely different option prices. For example, the 180 call or 185 call for GameStop is 2000 or 2153, but if you go to Disney and look at the same 185 call, it's just 340. Can you see how crazy is that? This is April 1, and this is also April 1. I'm looking at the same stock, same price, but this is costing almost 8 times more. If you expand this and look at the implied volatility, this is 300, which is huge. But if you go to Disney and look at the same implied volatility, this is just 40%. So this shows you how options can get really expensive when the IV goes up. So in other words, if GameStop is going to come down, if the IV of GameStop is going to come down to 40, then this option would come down to just 300. So options can lose 7 times of their value just by loss of implied volatility. In the same website, Market Chameleon, if you pull up GameStop, it was not always 300. Okay, so if you look at this, it was probably around the 70 range, 70, 77 last year in August, but it suddenly picked up, went to 400 in January and 300 in March, and right now it's at 265. So would I put an iron butterfly on GameStop right now? Maybe yes, but this is such a volatile stock, because if you see the stock performance, it was as low as $2 last April, and it has come up to 350. So basically, you're talking about a stock that traded between 3 and 300 compared to Disney. Disney is probably much, much more safer. And if you see the 1 year range, this probably traded between 90 and 200. So this is the range of Disney, and you know how much this can swing. But this volatility does seem like an attractive bet. Let's see if I can go to Tastybox and try to put an iron butterfly on GameStop. As soon as you open the option chain, immediately I see a problem, which is the bid-ask spread. So if you see the 175 contract, it is trading for 45 and 47. This is too wide if you want to get a fill, because an iron butterfly has 4 legs, and if each of them is $200 wide, you're going to lose almost 1,000 in just liquidity. So probably it's not a great idea to open it when the strikes are like this, but just let's look and see how their price is right now. So maybe let's do the 175. We're going to sell the 175 call and 175 put, and we can buy something further out. Okay, so what do we want to buy? This is giving you a credit of 88.25, which is huge, right? If we saw QQQ, we only collected like 900, but here we are collecting like 8,000. So you can even go bigger because this stock can move so much. So what if I buy the 250? Usually I go by the 1 month range for the stock. So let's look at what GameStop did in the last 1 month. The lowest is 120 and the highest is 300, which is huge. So probably $250. Yeah, let's do $250 on the upside. On the bottom, I'm going to do 100. Now this gives you a credit of 55, which is so much more than what we got on QQQ or even Disney. So this increases in value by $41 every day. So this is the amount of decay that this spread is going to accumulate every day, and you are risking 2,000 to make 5,500. And with the IV right now at 288, as it keeps going down, as the IV keeps going down, the value of this spread will really go down fast. So if I did the same on Disney, you know, this might not be 55, maybe just 500 or 600 if I do the same strikes on Disney. And the probability of profit is close to 40% here. So I have a very small account. I don't think I'm going to put this on. I usually don't risk more than, my max loss can be more than maybe 5% of my account, which is $500. So this is not something I can put on, but yeah, this seems like a fun trade that you can really try. So assuming that the IV might go down even more and you are going to collect $40 in theta decay every day, this definitely sounds like a pretty good trade. But the only problem is that GameStop is a very high volatile stock. So if you put this on the next day, it jumps so much, you might have to scramble around to cover this position. But yeah, the risk is there, the reward is there, and maybe right now it's not for me. Okay, some surprise. I did not plan to add this to the video, but I happened to check on GameStop the next day and I found out that the spread we were talking about has already gone down by $200 in value. Because GameStop today, if you see, has been pretty flat and made just a 0.5%, 1% move. And if you look at the ironfly we discussed, it's already down to 52, and it was yesterday when I recorded the video, it was 54 as you just saw. And if you look at the implied volatility, it is now 283%, and when I recorded yesterday in the actual video, it's 288. So that is a 5% drop in IV, and combined with the theta decay of $40, you have already made $200 profit. If you had put on the trade, you are already up 200 on this trade in 1 day. And the more GameStop continues to go sideways, the more GameStop goes sideways like this, you will continue to see the trade make more profits. But any sharp upside move or down move, you might see that you start losing. So maybe 2 or 3 days. Just keep it for 2 or 3 days and hope that it stays in a range and you can walk out with an easy $500 winner. I would not keep it till expiration because, if you keep a GameStop trade for a month, you know what can happen, right? So you just want to find a range for maybe a few days where it is trading flat and get in, get out with a quick winner. So that's how ironflies should be done. You don't want to keep it till expiration and play the pinning game of trying to make the stock sit into some weird sweet spot. Just trade the IV and trade the DK and walk out. Not for me. So if you have a very small account, you can do this on a smaller stock. Maybe you can do this on AMC, which is a $10 stock right now. So you can do this here and you will have much less risk if you try to put on something like this. Okay, so you can even do this on Express. Okay, Express is a $4 stock, and definitely we can put something on here. Okay, 2 weeks back I posted a trade on Express. Basically, it's an ironfly, which is what we're talking about right now. So this is how the trade looks like. I took the screenshot just before the earnings, which is like 2 weeks back. This is for the April 16th strike. You are selling the $5 call and put and buying the 2 and 8. So basically, you are risking 92 to make 200, okay? And because this was before the earnings, the IV was higher. I'm going to put on the same strikes right now and see how it looks. So we want to sell the $5 call and put, and then buy the 2 and 8. Okay, so here is how it looks right now. If you see this, right now this is trading for 136, which means if you open this trade, as shown in the screenshot, 37 days before expiration, you could have collected like $208 credit, and today you can close it for 136. And if you even add up the slippage, you can even close this for maybe 125, right? Or even 140. So you could easily still make a nice winner if you had put on this trade. So the IV was in the 200 range before earnings, and right now it's just 150. I tried to put on this trade on that day, but I couldn't get a fill. But it seems like this would have been a winner if I had put it on. Okay, I hope you got some idea on how an ironfly works and what is the right situation to make a profitable ironfly and how IV affects this particular trade. I know it's been a long video, but if you have been watching until the end, thanks for staying back. Good luck with your ironflies. Let me know in the comments below if you have any questions. Okay, thanks again for watching, and I'll catch you in the next one.